How much do you need to retire in Singapore today, and how should you go about to structure a portfolio that is both inflation and recession proof? In this video, I will share with you on my retirement plans, how I intend to structure my future retirement portfolio, and as a result, how much would I need. Now bear in mind that this is how I would like to do things for myself, so my portfolio, my rules. Please seek proper financial advice if you need help in structuring your retirement portfolio to address your own needs. Without further ado, let's get started. Portfolio objectives and methodology. Now at the end of the day, retirement is all about addressing the age-old problem of how much do you need and where will the money be coming from. Now mixing the loss of a purchasing power as a result of inflation, and you find yourself in a situation where you have to have a steady stream of income that increases with inflation without exposing yourself to too much external risk. In other words, the ideal retirement portfolio is one that provides you with an adequate income that keeps pace with inflation and has a very high level of safety of capital. And as the saying goes, all roads lead to Rome. There are countless ways you can approach your portfolio to achieve the objectives that I've laid out earlier. For myself, I find it easier to manage a portfolio if I were to keep the income generating assets separate from the capital appreciating assets, and because of that, the idea behind my portfolio will look something like this. Firstly, the monthly retirement income needed will be derived from income generating assets. Now these are also asset classes that have high levels of safety of capital, such as your government bonds, annuities, fixed deposits, and etc. Now these are also instruments that are easy to manage and will not take up too much of your time when it comes to monitoring the markets and managing your overall portfolio risk exposure. Secondly, to combat the loss of purchasing power, the pool of income generating assets should grow at the same pace as inflation rate itself, of which the source of funds will come from the capital appreciation of the growth assets themselves. Now these are instruments that often comes with higher risk and reward and will require more time and skill when it comes to managing the portfolio to deliver the performance that is needed. Asset classes include things like equities, cryptocurrencies, derivatives, and all other alternative assets. Now with this type of portfolio structure, how much do you need to achieve a self-sustaining inflation-hedged portfolio to retire here in Singapore? And that brings me to the next part. How much do you need to retire in Singapore? Now given the portfolio objectives, methodology, assumptions, and restrictions, for a monthly income of $1,000, you will need a total of $400,000 if you want to retire today. The income wanted and the amount needed will scale proportionately, meaning to say that if you need a passive income of $2,000 a month, you will need to have $800,000. And if you need a passive income of $3,000 a month, you need to have $1.2 million, so on and so forth. Now assuming that you do not have the amount that is needed to retire today, how much do you need to save and invest to achieve the same desired retirement income in the future? By running through the different scenarios of having different investment duration and returns, the following are the monthly investments necessary to achieve the amount highlighted in yellow. Any investment amount more than $2,000 a month will be highlighted in red, while any amount below $2,000 a month will be highlighted in green. Now if you are thinking of retiring anytime between 15 to 25 years from now, while having the purchasing power equivalent of $2,000 to $3,000 today, your focus should be on accumulating at least 1.2 million and above. From the above findings, it is evident that if you are starting from zero and would like to create a passive income generating portfolio that is inflation hedged, you will need to set aside around $2,000 to $3,000 a month for wealth accumulation purposes. How would my ideal retirement portfolio look like? I will allocate 30% of my assets into fixed income instruments that are capital guaranteed or with a super high degree of safety of capital, as these are instruments that will have little to no volatility risk at all. I will then allocate another 30% to S-REITs index to gain exposure to the rental income from the various industries, thereby diversifying my risk while ensuring that my liquidity needs are being retained, as opposed to investing in a physical residential property. The remaining 40% will be split between the dividend-paying blue-chip stocks, which will take up about 10% of the allocation, while growth equities will take up the remaining 30%. Now this is the part of the portfolio where I will be focusing my time and attention the most on, as it requires more hands-on management to ensure that the portfolio can perform while managing the overall volatility of the portfolio itself. As the portfolio grows with time, a rebalancing will be done, where the growth equities and dividend-paying blue-chip stocks will be rebalanced into government bonds or their equivalent, annuities if the minimum sum is viable, and REITs if the valuation is fair. All things considered, the portfolio will provide me with a regular income that I need, while ensuring that the capital growth of the portfolio can at least meet the inflation rate of 2.5% and maintain an annual portfolio volatility of around 11%. Now, in a worst case scenario of a recession or financial crisis, if we were to assume a low to no dividend payout ratio scenario for equities, the portfolio should still be able to produce half of its previous income, as a good chunk of the income source is secure. In terms of a maximum drawdown, the portfolio should suffer no more than a 36% decline in valuation if we were to assume that all equities were to suffer from a 50% drawdown. That said, given that our portfolio only includes things that are either of high quality, like your blue chip stocks, or backed by real assets like your REITs, these items are expected to recover with time, and our value at risk in this case is only limited to growth equities, which historically speaking has always recovered, as long as we are investing in quality businesses and are adequately diversified. Limitations of this approach or calculation. Now obviously this is a very simplistic approach to planning for retirement, as number 1, it assumes a pure passive income approach instead of a drawdown approach. Number 2, it neglects the use of CPF and its implications in the portfolio, and number 3, it adopts a linear approach and neglects the unique individual needs and circumstances. That's it. This is how I would approach my retirement, which will be very different from how you intend to approach your retirement. If you need financial advice in areas like wealth accumulation, portfolio management, and retirement planning, you can find out what I do on my website and get in touch with me directly to see if my services are suitable and can value add to you. Subscribe to this channel or follow me on Instagram to receive a 1-minute daily market update and be updated with future upload. In my next video, I will be ranking the different income generating assets, so do keep a lookout for that video. Stay safe and I hope to hear from you soon.